The most dangerous tax in America is the one that never sends you a bill. It does not arrive in a thick envelope. It does not need a vote in Congress. It does not have a slogan. It shows up as a number so small you stop respecting it. A savings rate that looks harmless, an inflation rate that looks manageable, a spread between the two that quietly eats your future while you congratulate yourself for being safe. If you have $200,000 in a bank and the bank pays you $800 for the year, while inflation strips away $5,000 of purchasing power, you did not earn interest. You paid a toll. That is the first thing I want you to understand. Most people think they are parked in a safe place when their money sits in a bank account earning almost nothing. I think they are already on a toll road. They are driving every day. They are paying every mile. They just do not see the booth because the toll is not taken in dollars alone. It is taken in purchasing power, in optionality, in future freedom. In the deals you will not be able to make later because you let your cash grow old in a machine built to weaken it. I have spent my life studying incentives. If you want to understand what is happening to savers, stop listening to the slogans and start studying the toll road, who built it, who collects from it, who gets waved through, who gets pushed into the slow lane, who is told that a rough road is the same thing as a safe road. On the 1st of April, a new banking rule takes effect that matters more to the ordinary saver than most headlines. They will read this year. It lowers capital friction for the largest banks and frees up a huge block of balance sheet capacity, roughly $210 billion by one estimate, which makes it easier and more profitable for those banks to hold government bonds. You do not have to be a lawyer, a regulator, or a central banker to understand the consequence. When a bank is given a better regulatory path to earn a decent return by buying government debt, it has less reason to compete aggressively for your deposits. That is the captive buyer trap. The public story sounds technical. The real story is simple. The government needs financing, the banking system is being nudged to become a more convenient buyer, and the saver is the raw material that makes the whole road function. Your low deposit rate is not just a disappointing feature of the landscape. It is part of the pavement. This is where ordinary people get fooled by language. When I hear a phrase like enhanced supplementary leverage ratio reform, I know I am being invited to sleep. The more polished the label, the more carefully I check my wallet in finance when they want the public to ignore the transfer. They wrap it in a phrase that sounds like equipment maintenance. What they are really telling you is that the toll booths have been moved, the lanes have been widened for institutions, and the cost has been shifted onto drivers who are too busy or too trusting to study the map. If your bank can buy treasury paper and earn a regulator, less return with less friction, why would it fight to pay you 4% on a savings account? It will not. It does not need your approval. It only needs your inertia. That is how financial repression works in the real world. It is not a dramatic seizure. It is not soldiers at the vault. It is a long stretch of bad road combined with a smiling toll collector. You keep driving because the sign still says safe. You keep paying because nothing looks broken enough to trigger panic. Meanwhile, your tires wear down, your suspension weakens, and the distance between where you are and where you thought you were going gets wider every year. I want you to make one subtraction. Take your savings yield, subtract the inflation rate. If the number is negative, you are not being rewarded for prudence. You are financing someone else's problem. Call that the silent toll. The United States is carrying an immense debt load. Interest expense is now so large that it sits among the biggest line items in the federal budget. When a government reaches that point, it has very few pleasant options. It can tax openly, it can cut promises, it can default openly. Or it can choose the old political favorite. It can borrow cheaply and let inflation do the dirty work. It can melt the debt in real terms while the public argues about everything except the arithmetic. Governments prefer the silent method because explicit pain gets people angry. Implicit pain gets people confused. That is why I pay attention anytime I hear talk of tighter coordination between the Treasury and the central bank. It is presented as pragmatism. It is often sold as modernization. But if you know the history, you know what can hide inside that language. There was a period in the 1940s and into the early 1950s when the central bank was effectively pinned to the government's financing needs. Rates were managed, inflation ran, savers were sacrificed, then came a break toward independence. That break mattered. It was the moment the central bank stopped being a direct servant of the Treasury's borrowing convenience. Whenever someone says they want a new Accord while the debt mountain is this large, I do not hear poetry. I hear road crews preparing to reroute traffic. The important thing is not whether every official uses the same words. The important thing is whether the incentive system points in the same direction. And right now the incentives are obvious. A heavily indebted state wants lower funding stress. Large banks want profitable, low-friction assets. Wall Street wants spread. The saver wants safety. The saver is the weakest lobby in the room. So the saver gets designated as the road. This is not abstract. It reaches right into the kitchen table. A family sees more property tax, more insurance, more groceries, more repairs, more tuition, more medical costs, yet the account that was supposed to be the safe harbor pays a rate that belongs in a museum. The family thinks the danger is the stock market because the stock market is noisy. I think the danger is the parking lot because the parking lot is where money goes to die quietly. $100,000 in cash that lags inflation year after year is not stable capital. It is shrinking timber. It looks solid until you realize termites have been inside the walls for a decade. Now we come to the part almost nobody explains honestly. There are two roads, not one. There is the short road and the long road. The short road is where your savings account, short-term borrowing costs, and headline policy rates live. The long road is where your mortgage, your refinance rate, and the long cost of capital live. When politicians or commentators talk about rate cuts, ordinary people hear one sentence. I hear a split roadway if short-term rates fall. The headline says relief. Maybe your cash yield falls with them. Maybe your revolving debt eases a little. But if the long end is being pressured upward because the biggest structural buyer steps back or because bond supply must clear at a higher yield, then your mortgage world does not receive the same relief at all. That is the long end ambush. This is one of the cruelest tricks in modern finance. The public is told there's been a rate cut. The public imagines cheaper money everywhere. But if long rates rise while short rates fall, the government gets part of what it wants, institutions get part of what they want, and the household trying to buy or refinance a home may get the opposite of what the headline promised. That is why I do not respect television language very much. It flattens a mountain range into a sidewalk. It tells the family in the driveway that all rates are moving in the same direction, when in reality one lane is open for the state and another lane is narrowed for the homeowner. So let me say it plainly, a policy mix that cheapens your deposit yield while failing to improve your mortgage reality is not neutral. It is a transfer. It is the toll road operating exactly as designed. Most people respond to this by becoming either complacent or theatrical. I have no use for either reaction. Complacent people stay on the road and keep paying. Theatrical people scream about collapse and still never make a balance sheet decision. I prefer arithmetic and positioning. The first psychological injury of the toll road is this. It punishes the virtue that school taught you. Save, be cautious, avoid risk. Put money in the bank. That advice worked in a world where the road was maintained, honestly. It fails in a world where the toll collector, the road owner, and the debt issuer all sit in adjacent offices. You can do everything that sounds responsible and still get poorer. That is hard for people to admit because it feels like betrayal. It is easier to pretend nothing changed, but the saver who refuses to update his model becomes the permanent donor. The second injury is even worse. A low-yield account teaches passivity. It makes you feel as though inaction is a strategy. It turns time into an ally in your imagination when time is actually working for the toll collector. Every month you leave meaningful cash where it earns far below inflation. You are not pausing. You are traveling in reverse. The third injury is moral confusion. People start calling dead money conservative. I do not. Conservatism is not refusing to move. Conservatism is preserving purchasing power. Preserving optionality, preserving the ability to act when markets, businesses, or properties are mispriced. If your cash is guaranteed to lose in real terms, that is not conservative, it is obedient. Now let me tell you where the toll road expands from deposits into housing, because this is where millions of households make the exact wrong choice while thinking they are being prudent. If you have a fixed-rate mortgage below 5%, especially well below it, you may be holding something more valuable than you realize. Most people see debt and immediately want to kill it. I understand the emotional appeal. I also understand arithmetic. Debt is not one thing. Expensive floating debt and cheap long-term fixed debt are not cousins. They are strangers. A low fixed mortgage in an inflationary world can be an asset disguised as a liability. Call that inflation arbitrage. If your borrowing cost is modest and the currency is slowly being weakened, then the real burden of that debt shrinks over time. The government understands this perfectly. Wealthy operators understand it perfectly. Yet the ordinary homeowner is often trained to do the opposite of what the state itself is doing. He rushes to extinguish cheap fixed debt while the issuer of the currency is letting inflation trim its own obligations. I am not saying debt is virtuous. I am saying classification matters. Paying down a 3% fixed mortgage aggressively while your liquidity is weak and your cash opportunities are better elsewhere can be a capital allocation error. Every extra dollar shoved into that house may feel holy, but feeling holy is not the same as becoming stronger. What matters is not just return, it is optionality. If you pour every spare dollar into walls, the walls do not send you a monthly check. The walls do not let you strike when an opportunity appears. The walls do not keep you calm. When insurance spikes, taxes rise, a roof fails, or a job disappears, a paid-off house can provide emotional relief. It can also produce frozen capital. That is another toll booth few people notice. They retire their money before they retire themselves. A house with meaningful equity and no income attached to it can become a silent vault in which your capital sleeps while inflation works outside. I love productive assets. I have spent a lifetime buying them. Productive assets give you options. Sleeping assets require you to admire them while the road keeps charging. So what do I do with this framework? I begin with liquidity that actually pays something real. Not symbolic, not insulting. If a savings vehicle can give me a rate that closes much of the inflation gap or at least competes, honestly, then I use it for true reserve capital, and I watch it like a hawk. Banks lower rates quietly because they know inertia is profitable. That means quarterly vigilance is not paranoia, it is maintenance. Then I separate reserves from dead cash. Reserve cash is money with a job. It protects me from forced selling, from urgent stupidity, from turning temporary stress into permanent loss. Dead cash is money sitting in a place chosen by habit rather than by design. The toll road loves dead cash because dead cash never changes lanes. Then I classify my debts. High-interest consumer debt belongs in the shredder. Cheap fixed long-term debt deserves colder analysis. If inflation is doing part of the repayment work for me, I do not rush to help it out of sentiment. I preserve the war chest instead. That phrase matters. War chest is not fear money. It is refusal power. It is what keeps you from selling businesses, securities, or property at stupid prices because life backed you into a corner. It is what allows you to say no to a bad buyer, no to a predatory lender, no to panic, no to the toll road's favorite outcome, which is to make you transact at the exact wrong time. Many people imagine strength as being debt-free. I often think of strength as being unforced. That is why liquidity tools matter before you need them. A line of credit established while your balance sheet is healthy can be worth far more than a line begged for after circumstances deteriorate. Optionality obtained early is cheap. Optionality requested late is expensive or unavailable. I do not worship leverage. I worship preparedness. The ordinary saver also needs to stop confusing nominal safety with real safety. If $100,000 can lose a third of its purchasing power over a decade while looking perfectly calm on a statement, then the calm is cosmetic. Real safety is the ability of your assets to hold or grow real buying power across time. Sometimes that will include high yield cash equivalents, sometimes short government paper, sometimes productive equities, bought sensibly, sometimes hard assets. The point is not the costume. The point is whether the toll road is still billing you. I am not telling you to fling your reserves into speculation. I am telling you to stop volunteering as the government's underpaid lender. That may sound harsh, but harsh arithmetic is kinder than soft delusion. When a government carries enormous debt, it does not need to confiscate openly to extract from savers. It can rely on what I call the compliance tax. That is the cost paid by people who continue following yesterday's rules after the road has changed. They remain loyal to the institution, loyal to the old script, loyal to the familiar account, loyal to the notion that safe means still. The system loves them because they never ask whether the toll has gone up. You should ask. Open your bank app. Look at the yield. Compare it with inflation. Compare it with available alternatives. Compare it with the return your bank can earn on government paper. Then ask the only question that matters. Who is getting the spread created by my passivity? That spread is not a mystery, it is the incentive. And once you understand incentives, a great many stories collapse. You stop waiting for a villain with a cape, you stop needing a conspiracy, you realize a machine does not need evil intent to grind you, it only needs aligned incentives and sleepy drivers. The toll road has other secondary effects that people miss because they focus on one booth at a time. Low deposit yields train households to chase yield recklessly somewhere else. That leads them into bad products, lazy promises, and salesman language. Mortgage confusion leads them to anchor on headlines rather than term structure. Rising living costs make them feel broke, which increases the temptation to seek relief through consumer borrowing. So the same system that weakens savings often creates future borrowers who will pay more somewhere else. The road collects in both directions. I have no patience for that trap. If your cash earns too little, the answer is not to start acting stupid with the rest of your capital. The answer is to design a layered defense, real liquidity, smart liabilities, productive assets, a close eye on purchasing power, and above all, a refusal to be hypnotized by the word safe when the numbers say taxed. There is another truth here that most people resist because it feels offensive. The state prefers your savings more than your savings prefer the state. Think about that. A heavily indebted system has a deep appetite for pools of passive capital. The saver thinks he is choosing a quiet life. The system sees feedstock. That is why the road metaphor matters. You think you are driving on public infrastructure. In reality, you are part of the infrastructure. The saver provides cheap funding, the bank intermediates, the state borrows, inflation trims the real burden, the public argues about personalities, the road remains open. Now let me tell you what I would test in my own life if I were standing in your kitchen tonight. I would circle every place where I am accepting a negative real return because of convenience. I would circle every debt whose headline label is emotionally ugly but mathematically useful. I would circle every chunk of trapped equity that gives me pride but no flexibility. I would circle every assumption I inherited from an earlier era of banking and ask whether it still matches the actual road beneath my tires. That exercise alone would put most people ahead of 90% of savers, because most savers never conduct a linguistic autopsy on the words used around their money. They hear reform and assume improvement. They hear safer banking and assume safer savings. They hear rate cut and assume cheaper mortgages. They hear responsible and assume rewarded. I assume nothing until the subtraction is finished. The people who come through periods like this with their freedom intact are rarely the people with the most elegant opinions. They are the people with the cleanest cash management, the clearest liability classification, and the highest respect for real returns. They do not get seduced by jargon. They do not donate years of purchasing power to a bank out of laziness. They do not use all their liquidity to worship a cheap mortgage. They do not let an inert home become a shrine while their future starves for flexibility. They build fortresses before the road gets rougher. And I suspect the road is going to get rougher. If the next year or two brings the kind of coordination many people are hinting at, you could see a world where short-term policy optics improve while long-term household financing remains stubborn, where banks become more comfortable holding government paper, where savers continue receiving yields that lag real life, and where the cost of servicing public debt is pushed quietly onto people who never receive an invoice. That is the soft default. No speech will call it that. No law will print it that way. But if the state reduces the real burden of its debt through a mix of inflation, suppressed household yields, and regulatory steering, the saver has still paid. He has simply paid without the dignity of being told the truth. I do not like paying without dignity. So here is the standard I use. I want my cash to earn honestly. I want my liabilities to be classified rationally. I want my home equity to be evaluated as capital, not as a sacred object. I want enough liquidity that I am never forced into a bad sale. I want some exposure to assets that can survive currency weakness. I want every dollar to know its assignment, and I want to make these decisions before the crowd notices the toll signs. That is not panic. That is stewardship. The great advantage you still have is that the road is visible if you are willing to look. The rule changes are public. The debt math is public. The history is public. The inflation spread is public. The trick is not that the facts are hidden. The trick is that they are fragmented and wrapped in language designed to keep you from connecting them. Connect them. You are not merely choosing where to park cash. You are choosing whether to remain a passive funding source for a debt machine that needs your patience more than it deserves it. You are choosing whether to keep applauding a statement balance while your real purchasing power is hauled away one quiet month at a time. You are choosing whether to keep sending extra dollars into a very cheap mortgage because it feels clean, or whether to preserve the war chest that may one day buy you a business, save you from a forced sale, or let you act while other people are trapped at the toll booth. You are choosing whether your balance sheet will be designed or inherited. That is the door. On one side is the compliant saver. He trusts old labels, accepts low yields, overpays cheap debt, traps equity in sleeping assets, and wakes up 5 years later wondering why discipline did not produce strength. On the other side is the active allocator. He studies the road, counts the tolls, changes lanes early, keeps liquidity alive, treats purchasing power as sacred, and refuses to finance a giant machine at charity rates just because the booth looks official. I cannot make that choice for you, but I can tell you this. In the years ahead, the distance between those two people will not be measured in basis points. It will be measured in freedom. And freedom once lost to a toll road you refuse to recognize is very expensive to buy back.